Alright, fam, today we're getting into the Fibonacci retracements and extensions. And listen, this is one of those tools that can level up your trading game if you use it right. So if you've ever wondered, where should I enter a trade? Where do I take profits? Where will price possibly retrace? This is the tool that's for you because the market moves in patterns and Fibonacci is going to allow us to recognize those. So by the time we're done, you're going to know when to use Fibonacci retracements to find solid entries and when to use the extensions to set your price targets and also how to avoid the common mistakes that trip everybody up. All right. So let's get into it and do a deep dive into using Fibonacci tool for trading success. Our lesson objectives today is by the end of this recording, you will know what Fibonacci retracements are and why they work, how to use them for precise entry points, what Fibonacci extensions are and how to set profit targets, and how to combine Fib with other tools so you're not just trading blind. This is about stacking your probabilities in your favor. That's all technical analysis is. Stack the high probability signals, high probable signals, and put them in your favor. You only want to take high probability setups, and the Fibonacci, I promise y'all, is going to help you to be able to identify them. But before we even get there, let's take it back to middle school math for a second here. And babes, don't click off this video yet just because I said math. I am not a mathematician, and I figured it out. So let's get to it. The Fibonacci sequence is this never-ending string of numbers that comes from adding the two previous numbers together. So if we take 0 and 1 and we add those up, we get 1. Now if we take 1 plus 1, add those up, we get 2. If we take 1 plus 2, we get 3. 2 plus 3, 5. 5 plus 3, 8. 8 plus 5, 13. 13 plus 8, 21, and so on. Why do we care about some ancient math sequence when we're trading? It's because these ratios within the sequence show up everywhere. And I'm not just talking in trading. It's going to be in nature, architecture, the human body, and most importantly for us, the stock market. So traders, we use these ratios, particularly the 61.8%, which is our golden ratio, to measure where price is likely to pull back and bounce or where it might extend and run further. Remember that the market moves in cycles. We move in cycles and we only have 4 phases, okay? The Fibonacci is going to help you to recognize that rhythm, basically. If you've been trading for a good little minute, you've seen price go up, pull back, range, consolidate, stay in the same place, continue on, all of this stuff. That's because the market doesn't just move in a straight line. It moves in waves. Hear me close, babes. It moves in waves. So these pullbacks aren't random. They tend to land at specific Fibonacci levels, which is why we use the tool, so that we can anticipate where price might react. So think of it like walking up a flight of stairs. All right. One of my favorite quotes is, faith is taking the first step without seeing the entire staircase. You don't just jump from the first step to the top. You step up, we pause, we pray about it, and then we step up again. The Fibonacci retracement tool helps us spot these pauses, aka the retracement, so that we don't buy too early or sell too late. And again, we can depend on them, or we can rely on them with confidence because it's innate. This sucker is everywhere. Y'all, it's even in our fingers, or in our hands. So let's think about this. So we have 2 hands, and on each hand we have 5 fingers each. And then if you look at your finger, you're looking at it from the inside, you have 3 parts to your finger. Oh, what? Are we coming up with 2, 3, 5? Are we seeing these numbers? They're everywhere. Have some confidence in your fib levels. We just want to make sure that we mark them right, which let's just continue on with that. Now, I do want to explain some of the Fibonacci retracement levels to you. When we look on our indicator tool, if you're using TradingView, it's going to say 0.236, 0.382, 0.5, 0.618. Let's talk in percentages right now. But the 23.6, this is a shallow pull. It'll have a weak reaction. The 38.2 is a moderate pullback. Okay, this is kind of moderate. It's potential continuation. Now that 50% is not a fib level. not a true Fibonacci number, let me say that, but it's very much so used because as humans we tend to at least do things halfway, child. So the 50% is a psychological level. Now that 61.8%, that's that golden ratio. This is strong support or resistance. We want to see price get back to this 61.8. In the 78.6, this is a pretty deep pullback, and it's that last line of defense that we got. All right. So if price is pulling back less than 23.6%, that's barely any retracement. Again, let's look at the first one. It's a shallow retracement. So that's just like someone's tripping and just immediately catching themselves. Like you kind of trip before you hit the ground, you catch yourself. So no real pullback, just straight continuation. You right back up. Now, if the price pulls back to 61.8 or the 78.6%, that's like someone, child, you fell to the ground. You need help to get up, okay? You bent down to tie your shoe and got knocked over by the wind, something like that, before you could continue up. It's a deeper pullback, but the trend is still intact. As long as we hold those levels, the trend is still intact. You took a stumble and you needed some help getting back up, okay? All right, so let's get technical with it. How do you actually use this on your chart? I'm going to walk you through and explain this because I want you all to have this for your note taking so you can screenshot it as well. But of course, we're going to get visual on the chart too. So don't worry, y'all keep listening. So first up, we need to find the trend. Look at the last big move. Was it up or down? Was price going up or was price downtrending? After you determined if we're in an uptrend or a downtrend, you then need to mark the swing high and the swing low, which is just the last high, the last major high and the last major low. Okay. So if we're in an uptrend, you're going to want to start at the swing low and drag it to the swing high. Okay. Because you want to know what are the retracements from the lowest point to this highest point. We're in an uptrend. You want to know where the retracements are as we're in an uptrend, so you start from low to high. In a downtrend, you're going to start from the swing high and drag it down to the low because you want to know where is price retracing when it's downtrending. We're still using the retracement tool because in this moment, what you're wanting to find are your retracement levels. Fibonacci retracement levels, okay? After that, just let the Fibonacci tool do its thing. The levels will appear automatically, or whether you're charting on TradingView, Thinkorswim. I also saw them on Interactive Brokers. I don't believe it's on Webull, but I haven't done my due diligence. I know that you will if you are using Webull to chart. So before I even leave this slide, here's the thing. You have to draw these correctly. You don't just get to decide, oh, I'm going to start at a low and we're in a downtrend. That don't even make sense, babes. It doesn't. Don't just slap it anywhere. If you misplace it, your levels aren't going to mean anything. So let's talk about when we want to use the retracement versus the extension. And when we want to use both of them, honestly. So let's clear up the biggest mistake that traders make, and it's using the wrong tool at the wrong time. Pretty much what we were just hitting on. You're going to use the Fibonacci retracement when you're looking for an entry. If we are in an uptrend, making higher highs, higher lows, and you see that price is pulling back, making that low, you want to use the Fibonacci retracement so that you can find an entry. You want to find where is price going to pull back and retrace to, same thing, right? Before it continues on. You're going to use the Fibonacci extension when you're looking for a take profit target. It doesn't matter if you're looking for a take profit target that's above you or below you. We want to use that extension because it's going to give us those, it's going to calculate those levels for us above the range or below the range, outside of the range that we're currently in. So remember, the retracement is about pullbacks where price might pause before continuing, and the extensions are about targets. And that's where price might go once the trend has continued. All right. So let's look at an example of using the Fibonacci retracement in an uptrend. Okay, so here is a real example. Notice how price is pulling back to the 61.8%, and you can see the code bar down there with the black line and the green dash line and all those lines are. You see it right there. So when it pulled back to the 61.8% level and then it took off again, that is our entry confirmation. If price had broken below the 78.6 level, that would be a warning sign that the trend might be falling, right? Remember the 78.6, that's that last level of defense before the trend is invalidated. I don't necessarily want to see that too much, okay? A little bit more in depth. The black line represents price movement. The green dash line is the swing high, okay? The red dash line is the swing low. The dotted lines are just our Fibonacci retracement levels where, again, price might find support and continue to trend. As we see, that's what that did. The Fibonacci retracement in a downtrend. So the example that I have pulled here is Chevron. Now I had to go ahead and pull this out here. I started at this swing high because we see that the last true we had a downtrend. This is my swing low, and we see that these are the highs it made, but this swing low came from these highs here. Right? This was the initial drop, a downtrend. So I used the Fibonacci retracement and I started at the highs and I brought it down to the lowest point, the swing low, and just spread it out. Again, I'll show y'all when we pull up TradingView how you would go in there and mark it off. But here, as we see, look here, price pulled back to the 0.382. Here, we see that it was holding the 382. We went above the 0.5 and we have the 618. Now look here, when it failed to make a new high, when we failed to make these new highs and we came back below, it lost the 618, it lost the 0.5, it lost the 382, you was coming on down there to the 23 points, yay, you was coming on down there, and it held it here, and we came back above the 382. We see how it bounced off of the 382 here and closed above the 0.5. We got, when price moved above the 61.8%, this would have been a beautiful day trade that you could have caught, or a swing trade, because I am on the weekly time frame on this example. So when we saw Chevron moved above $154.82 this week, you could have had a beautiful swing trade all the way up here into the $160 range. $160+ range. All right. Now we can see here that in these last few weeks, Chevron is holding the 618 as support. You are holding that 61.8% as support. I would not be surprised to then see price move above the 78.6% and continue on. Now, if we fail here again, challenge, we got 3 lower lows, or lower highs. We got one high, second lower high, third lower high. If it fails to break above the 0.786, maybe I want to start from here and measure it down here, the Fibonacci retracement levels, and see what kind of love I get from there. I wanted to break down what a conservative, aggressive, and the best entry strategy would be. Now, a conservative entry is if you wait for confirmation. You want to see like a price action signal where there is a bullish engulfing or a bullish harami, whatever your favorite price action signal was with increased volume. You would want to see that on one of these levels. An aggressive entry would be entering at 50% at the 0.5 or right there at the 0.618. So if we go back to Chevron, this would be a fairly aggressive entry right now because you haven't confirmed that the trend is in fact going to continue. It's just holding the 618 right now. That would be an aggressive entry, and so therefore you need to have a very tight stop loss. And so in this example, my stop loss would be the 0.5. Yeah, I would never let you move down to 0.5 and not hold that. I'm going to go ahead and stop myself out. The best entry is, of course, to combine the Fibonacci. Y'all know I love a 4-for-4 setup. Are we looking at this Fibonacci tool while it's at a support trend line or resistance trend line or whatever it is with a price action signal? Bet. I'm ready to enter. Now, when we're looking at them for our exit points, your first target needs to be the previous swing high or swing low. Whether you're in an uptrend or downtrend, it needs to be the previous swing high or the swing low. Your second target, you're going to want to use the 127.2% and the 161.8% on the Fibonacci extension. Because remember, the Fibonacci extension is about targets. Retracement is about entries. Our third target is going to be go the at least 2 time frames higher than you are and look for the resistance or a key structural level. And that we're going to be kind of like third and final target. Now your stop loss placement is all below that 78.6% in an uptrend and below the 78.6% in a downtrend. It is the last line of defense. Do not let price go back above that 78.6 and you're or below and you're still in it. That's just, don't do that, babes. Don't do it. Once you're already in the trade, you need a plan to take profits. That's where, like we said, the Fibonacci extensions are going to come in. So price doesn't just stop at these random levels. It's going to follow the structure. It's going to follow the calculation. So whether it's the 127.2, 161.8 extension level, they are the most common targets. And if it's a really strong trend, it just might stretch out to the 200% extension. It just might. The best setups happen when you combine retracements and extensions. So an example trade setup is you're going to want to wait for price to pull back to the 61.8%, which is an entry signal, and then enter with confirmation, whether it's like we said, a bullish engulfing with increased volume, a pin bar with increased volume, whatever it is. But make sure you take partial profits at the 127.2% extension and then let the rest of the trade run up to 161.8%. Honestly, you should, like, using the Fibonacci extension, right? Honestly, just take the chicken and run. Okay, this is how you're going to use and trade with the Fibonacci levels with a purpose, not just randomly and putting lines all on your chart, right? So if you take nothing else from this, I want you to remember the fib levels are a tool, not a crystal ball. It works best with other confirmation. Y'all know how I feel about indicators. It should be your last step. Pay attention to market structure, the trend, price action, and then use the indicator, aka the Fibonacci level, as confirmation. Let's see how to use the Fibonacci retracement tool on the chart. We're going to go retracement. Very obviously, very clearly, we see that we are in an uptrend. So I'm going to want to start at the swing low, bring it all the way up to the swing high, and then just drag it across. And just drag it across from the low to the high. Look at this beautiful trend that price reacted to. OMG, is this JP Morgan pulling back to the 50%, the 0.5, and holding that? And holding the trend line as well? So how could I play this out? Well, very clearly, very clearly, my babes. We could say below 255, we're looking to target 244. Above 260, we're looking to target, I go above 260, we're looking to target 268.50, according to the Fibonacci retracements that we marked off here on the daily time frame. Look at this beautiful range that we have right here, and look how simple this is, you guys. And I'm going to turn this off now. Remember that you can just click rewind to look at where I had these levels at. Why wouldn't I want to trade this? Above 261 to trade into 268.50, or below, I'd have to do it below the 254. Let's put that back. We'd have to go below the 254 target in the 249.10. So I forgot to, let's mark this here too. Boom. Period. Period. Ugh. This is the range that we see JP Morgan is in. If we go down to the 15-minute, let's go to a lower time frame and we'll look at what price did. This is going back to January 16th on JP Morgan. Let's see how price reacted on these levels. What happened when we saw price move above our 255? Well, we got a strong move up to 261. This was in the same day. This was Friday, January 17th. To Friday, to the end of the day, Friday, January 17th. I'm not mad at that. We see when we got the retracement back to this level here towards the 261, the movement into the 268.50. And then the exact levels that it's respecting as price comes down. As price comes back down. So look here at this trend line here. And this is on the 15-minute time frame. This was on a Thursday going into Friday morning. We had this trend line here on the 15-minute. Imagine knowing that it just came back below, what was this, the 78.6 level? We just came back below there. It broke below the trend line. I should have nothing but expectations. And this was Friday afternoon that, hey, this is going to make it down as it did Monday morning to the 261. Losing 261, I should expect you to hear. You hold in here, I should expect for you to move back up. And if you know your trend line right on that Fibonacci level, as it's breaking it, all types of confluence, my babes. So I hope that this class helped, being able to have the standalone Fibonacci sequence levels. Ciao. I hope you learned something. I'll see y'all at the top. Bye.